London is the biggest foreign exchange market in the world. Yeah, the problem is that now someone big, someone that is kind of in bed with the regulators, it could be the government, is demanding delivery, and that kind of throws a spanner in the works of this fractional reserve paper leasing mechanism that in the LBMA is limitless. I mean, at least in New York, there's a limit, I think, to hypothecating gold.
The gold and silver markets in 2025 are facing unprecedented structural challenges, with physical delivery bottlenecks at the Bank of England reaching critical levels. Spot gold transactions, which traditionally settle within days, are now experiencing 4 to 8 weeks delays, an extraordinary situation that underscores mounting stress within the bullion market. These disruptions highlight a growing disconnect between paper gold contracts and the availability of physical metal, raising concerns about the stability of the global trading system. If such delays persist, they could undermine confidence in the London Bullion Market Association's (LBMA) ability to facilitate efficient transactions, pushing investors toward alternative markets with more reliable access to physical assets. Simultaneously, significant gold outflows from London to the United States have intensified, with estimates between 400 and 2,000 metric tons being transferred. StoneX, a well-respected LBMA member, has independently confirmed the movement of approximately 2,000 metric tons into American vaults. This substantial transfer occurs both within and outside the traditional COMEX framework. This shift suggests that a major player, possibly even the U.S. government, is securing physical reserves in response to growing concerns over the paper gold system. Such large-scale withdrawals could weaken the LBMA's dominance in the global gold market and force bullion banks to reassess their dependence on leveraged trading mechanisms that may no longer be sustainable. With London's bullion banks historically operating with minimal oversight, the strain on the system is becoming undeniable. The mounting evidence of a fractional reserve gold market, where multiple paper claims exist for each physical ounce, suggests that liquidity built on synthetic positions is nearing its breaking point. As delivery delays persist and major players demand real gold, bullion banks may soon be forced to cover their positions with actual metal, potentially creating a severe supply squeeze. Mario Innecco warns that this shift could fundamentally reshape global gold trading, with physical scarcity overtaking leveraged speculation as the primary driver of price discovery. If so, the long-standing reliance on synthetic liquidity may give way to a reality where tangible reserves, not paper contracts, determine market stability. We present the clips of Mario's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Back in end of January, beginning of February, it was said that it was 400 tons that went from the Bank of England, and then we to the U.S. physical. And then we also have been hearing from StoneX, who's a LBMA member and a pretty big bullion dealer, that it's more like 2,000 metric tons that have flowed into the United States. And the other thing is that it's not just, it seems to be flowing outside the COMEX mechanism as well. So not just through COMEX. The implications to me is that it could unravel the whole LBMA, basically fractional reserve scheme for gold, or virtual gold trading, whatever you want to call it, paper gold. And that's the thing, Jesse, the bullion banks and the bankers in general don't see anything wrong with that, because that's how they operate the current fiat currency system. The Federal Reserve, back in 2020, under Jay Powell's leadership, they removed all the reserve requirements for banks. So if you put a dollar with a bank, now they don't have to keep any in reserve. It used to be that I think they used to keep more than 10 or like 12%. Now it's nothing. And I guess it was justified maybe because of what happened in 2020, 21. But now we're in 2025 and they still have that. So that's what they do with gold, And they do it because they've been able to do it because most people, usually the funds and speculators, they trade gold on the LBMA, on the OTC market in London. It's just like a foreign exchange. It's like a currency trades. London is the biggest foreign exchange market in the world. The problem is that now someone big, someone that is kind of in bed with the regulators, it could be the government, is demanding delivery, and that kind of throws a spanner in the works of this fractional reserve paper leasing mechanism that in the LBMA is limitless. I mean, at least in New York, there's a limit, I think, to hypothecating gold. But in London, it's you can do it 100, 200, 300 times. And the LBMA, contrary to popular belief, the whole operation there, because of the Big Bang deregulatory or Big Bang rules in 1986, 87, under the Thatcher government, basically gave control of the gold market to the Bank of England, and the Bank of England said the bullion banks can do whatever they want. We're going to turn a blind eye, and that's the way it's run. It's self-regulated, and I guess Jesse, this might be things coming back to haunt them because they thought they could run a gold market based on basic mythical values, as I think President Putin called the Western financial system a few years ago, all based on, money created out of thin air. So LBMA, it's gold created out of thin air. And silver as well, of course. Investors are still focused on the general stock market, and maybe they don't. General investors, they're not value investors. They go with the herd, and they haven't sat down and done the maths of how much cash flow a lot of the miners are producing at these kinds of level, $3,000 gold. Yeah, maybe. I mean, one day it will change, but I don't know when it will be. It's improved a bit in the last few weeks. I've noticed with the miners that I hold.
Fiat currencies have suffered a staggering decline in purchasing power, losing 99% against gold since 1953. Yet this reality is largely ignored in mainstream economic discussions. A true monetary reset could be triggered by sharp gold price surges of $500 to $1,000 per day, exposing the fragility of unbacked currencies and forcing policymakers to confront the system's structural failures. As Mario Innecco notes, financial collapses tend to follow a two-phase pattern, where a sudden and chaotic breakdown follows a prolonged period of gradual decline. This mirrors Ernest Hemingway's famous description of bankruptcy occurring gradually and suddenly. The hyperinflation of 1920s Germany is a stark warning of how quickly public confidence can evaporate, leading to a complete currency collapse. In an era of increasing financial surveillance, physical gold and silver remain critical assets for preserving wealth and maintaining financial privacy. Their historical role as reliable stores of value becomes especially crucial during periods of monetary instability, offering protection against the systemic risks of fiat-based economies. Mario Innecco notes that the next monetary reset could be far more severe than past crises due to record levels of global debt and the unprecedented interdependence of financial markets. As confidence in fiat currencies weakens, the likelihood of a cascading financial breakdown grows, making gold and silver indispensable safeguards in an era of growing economic uncertainty. Let's get back to the interview.
On this kind of space that we are, the gold, silver, sound money space, we're well aware of it, and it is a growing space, but it's still, I think, minuscule otherwise, and I mean, when you talk to people, they have no clue about gold. They think that premium bonds are the safe place. Like premium bonds are a kind of government bond that you buy here, and they do a draw every month, and you might win loads of money. But no talk about gold.
They've got this lottery bond system there where you buy bonds, and if you're the lucky winner, you can get some extra cash.
Yeah, you can put £100 in a premium bond, and then they do a draw every month, and you might win, £1 million. But the odds there are huge. But people think, at least I've got a chance to win, and I can't lose my £100. But they don't understand that you're losing purchasing power by keeping those £100. I mean, gold here in the UK, the ounce of gold has gone from about 220 ounces, 220 pounds when I first bought gold here, to now 2,350. Currency's lost 10 times its value versus gold. And people are still, I think Jesse's because people are not, schools and even universities don't teach the fact that gold has always been money. And I didn't know this up until maybe 25, 26 years ago. I had to learn it on my own. As the dollar is concerned, I mean, it's lost since 1953, 99% of its value versus gold. The last percent can go on for a while because it's not like the drop to 99% happened like in 2 years. It's been happening for over 70 years. I think people might wake up, or our politicians and the people who run things might wake up when we start seeing gold go up 500, 1,000 or more a day. Then they'll wake up. Right now, I don't think they're still awake to it, even though I think it looks really bullish, the long-term chart of gold. I think it's going to be very hard to stop it going up. Or the way I like to look at it means that our currencies are in terminal. They've entered the phase of the, all of a sudden, I think it was the Hemingway's novel quote, "How did you go bankrupt? Gradually, and then all of a sudden I was bankrupt." I think we are entering that stage, and it doesn't take years. It could take less than a year. It could be very quickly. That's what happened in Germany in the 1920s. All of a sudden, the currency completely collapsed, i.e. people didn't want the currency. They wanted to get rid of it for anything that had some intrinsic value.
Gold's rally remains unstoppable as prices hold firm above $3,000, with $3,100 now seen as another step in its upward march. With an 18% gain in the first quarter, its strongest performance since July 1986, gold continues to attract investors seeking safety amid mounting economic uncertainty. The global trade war, fueled by President Donald Trump's import tariffs, has sent equity markets into correction territory, with the S&P 500 facing a 5% quarterly decline, its worst since July 2022. As fears persist, analysts see further upside for gold, with Bank of America raising its price forecast to $3,500 by 2027, though at the current pace, that estimate may prove conservative. Goldman Sachs and Société Générale are even more bullish, projecting gold at $3,300 by year-end or 2025, with the latter suggesting a potential surge to $4,000 if geopolitical tensions intensify. That's it for today. Share your thoughts on Mario's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.